We're back, guys, to talk about another really big event that happened and also a significant event that's just happening probably as you're watching this. But we're talking today with our resident expert, Tom, about First Republic Bank, its failure, what that means for the macro market, traditional finance, and equity. And we're going to go into the FOMC meeting that's expected to take place at the time of recording very, very soon. And the narrative that Jerome will be talking about so you can interpret or translate the kind of cryptic message he comes out with, and you know what to expect in the time ahead based on what they talk about.
Big news of the week. First Republic dies a peaceful death, goes to a better place. First Republic, 14th biggest bank in the US. Their business model was lending out to wealthy individuals with little or no interest. And they were doing that to booster their wealth management business. These were super rich people who wanted to buy another home in the Hamptons, another home in Silicon Valley, and they're really unlikely to default because they had all their money already at First Republic Bank. The tough part is as interest rates went up, the losses on these loans became too large for First Republic to actually bear on their books. All of these banks have capital ratios, so here's how many liabilities they can have for their assets. And because these loans looked like they were going to be potential big losers, their liabilities went way up. So First Republic needed a bailout from multiple parties here. Either the FDIC was going to be involved or another bank like a JP Morgan. JP Morgan swoop in the other day and actually purchase First Republic. They're buying all of the deposits the bank has. They're assuming all of those loans, and they're going to essentially be sharing any losses with the FDIC, which is sort of the backstop for all banks.
Exactly how does a very profitable bank go bankrupt in a very short amount of time? And aren't there risk mitigation kinds of things in place to prevent this from happening?
It's all about capital ratios. A bank, your liabilities are essentially your deposits, and your assets are the loans you're making. So if either your assets become a lot less valuable on paper or your liabilities go way up, those ratios go out of whack. So the biggest banks in the US need to maintain something like, a 10% to 13% ratio on the amount of assets and liabilities they hold to have a buffer. The issue is the types of loans they were issuing, how fast interest rates went up, didn't allow them to actually offload some of the loans or recover their losses over time. You can see that we've had deposits fleeing these banks, these smaller banks in particular, at record rates. Biggest deposit outflow since the Great Depression. And the only way to sort of mitigate those flows and to get people to start moving back into banks is to have rates be either less attractive outside of banks, and that's lowering the interest rates, or otherwise. So that's really the end game here is we're going to have to see rates come down, if no other reason, because banks need to be profitable. And if banks are not profitable, we don't have credit creation in the US. So we don't have any, sort of loans, velocity of money, all of those things that sort of push the economy forward.
I think that a month ago, people thought that the kind of banks going under was finished. And we now know that it's not. Do we think that we're going to see other banks go down?
It's going to be hard to see other big banks go down because they don't make the same type of loans as First Republic did. But, there's a broader problem here in that, you need these interest rates to come down to have the whole banking sector as a whole be profitable. Right now, the US government, if you see on the chart here, is, funding an enormous amount of debt. They're paying in the next 2 years alone, $2 trillion. They're not able to actually continue this policy unless, which is where I think the end game is yield curve control. And for investors, that means the government has to absorb this debt. The government has to purchase these bonds, which artificially suppresses interest rates and mechanically increases the value and interest in risk assets. We're not there yet, but this is where the end game is going, because as we've talked about numerous times, not if we have $10 trillion of debt we need individual countries or other consumers to absorb, that is a really, really exorbitant number, and a number that we haven't seen ever be absorbed in the market. So the Fed is the only place really who could backstop all of that, which should lower interest rates, which should make risk assets more attractive.
There was a recent tweet I read. I don't know where it is right now, and I don't remember the exact words, but it was something about Yellen doing some type of manipulation, I believe, in order to make sure that we don't have to raise a debt ceiling. Do you know what that was?
So essentially, we, as the US government, issue bonds. We fill up our bank account at the Fed. The Treasury fills up their bank account at the Fed. They take in tax receipts. They fill up that bank account as well. We lost the ability to issue more debt because of the debt ceiling. So Yellen has been going into that bank account and paying the bills of the US government. She's running into an issue where there's not any more money left in that bank account, or it's almost out. The projections right now are it's going to run out sometime in June because tax receipts were especially poor this year. That's the TGA, and that's what you hear people talk about. So we're going to have this debt ceiling showdown coming up. There's been a first pass by Republicans to say, here's spending, or here are the things we want you to spend money on. Here's the debt issuance you're allowed to do, and here's the reasons you can do it. And that's just sort of dead on arrival right now. So it's going to be a back and forth over the next month on where things go. But that goes back into the broader liquidity picture we've talked about a few times here. Once the debt ceiling debate's over and you stop having sort of, Yellen spending that bank account into the market and using those extraordinary measures, you're going to have a suctioning of liquidity. So that is going to be some real short-term pain as we kind of look at markets and as we continue to have, some other interesting things going on.
How are markets doing? I mean, both markets. I know. Well, I'm obviously aware of the crypto market. We had a bit of a pullback. It was just kind of dipping Bitcoin below 2,800 or 28,000, where I think as last week when we were kind of did our stream, it was closer to 30K. And how is also the equities markets doing? Are we seeing anything major over there, or this is kind of just normal volatility?
Big news in equities markets right now is so far about 75% of companies have reported earnings in the US. So that's earnings for Q1 last quarter. The earnings surprise, so up and above what they said they were going to do, has actually been really positive, which has surprised a lot of people, including myself. The notable thing here, though, is when you think about earnings, it's not just revenues, right? It's not just how much money is coming in the door, it's also the expense side. So they've actually, companies have been having strong earnings because they've been able to have the highest profit margins ever. So charge consumers way more than they have in the past, and reduce their expenses accordingly. So they've kind of manipulated the financials, and for how much longer they can keep doing that, I think remains to be seen. Credit card default rates are kind of tipping up, especially for 20, 30, 40-year-olds, those people who spend a lot of money. So it's going to be pretty tricky to see those continue, especially if you look at who's actually making the money for a lot of the S&P 500. 8 stocks have made all of the money this year. That's Amazon, Alphabet, Google, Meta, Microsoft, all of the tech stocks. I think a lot of people would consider discretionary income. So if your credit card's defaulting, you can't, your house price is going up, can you really afford to be ordering another package on Amazon? And can Amazon keep charging higher prices up and above inflation? I don't know. It doesn't seem like it to me. We're in this slow motion kind of cycle as things are kind of filtering through still in the economy. And the end game for the Fed is really tricky. Right now, they're going to hike rates in May. Depending on when you're listening to this, they may have already hiked already. The market here is pricing in another expectation for a rate hike in June, and that's about a 30% probability to date. Then the market's saying, hey, we're going to have a really bad recession because of all the things I've talked about, and we're going to immediately go to cutting. We're going to immediately reduce the debt burden on the US, and we're going to do it like that, which has almost never happened. So we're going to have this period of ambiguity where, the Fed needs to keep hiking because there are still inflationary pressures in the market, but you have the consumer starting to suffer pain, businesses kind of putting off the pain as much as they can and laying it on the consumer. And then, eventually the market's saying, okay, we're not going to be able to do this anymore. We're going to cut hikes and cut rates in the back of the year. For investors, the thing they really need to think about is when that happens, when that turn happens in the cycle, when do we start cutting rates? When do we start having the Fed using all of these extraordinary facilities? And or when do we get to the end game of yield curve control and the Fed starts buying assets again? When do we get back to QE? That is when risk assets will take off. Hard to tell exactly when, but end of the year, towards the end of the year seems likely.
And remind us again, what is going to be that trigger that allows it to happen?
The trigger that's going to have the Fed starting to purchase assets and the Fed cutting rates is broader economic turmoil and or something breaking in the economy up and above one bank. We need to see much more pain. We need to see unemployment rise. Right now, you're starting to see signs of that. You're not seeing all of those things kind of happen at once. That makes the Fed say, "Oh shit, we need to jump in and save the day." I don't think First Republic is the thing that broke that causes the Fed to start to pivot, but something will. It always has. So we need to be mindful of that and really make sure that we're careful in thinking about how we position accordingly.
So what else can we look at besides bank failures that might create that breaking point?
There's a lot of strong leading indicators that can show kind of where the economy is going and when we could see issues. The biggest and most important one is manufacturing. And they survey and look at this data on a monthly basis. Anytime we have the manufacturing index falling and all of these indicators slowing, you've seen really painful risk asset returns looking 12 months forward. So you don't need to wait until something breaks to be cautious. You could just say, hey, things are slowing down, unemployment's starting to rise. I see the signs that consumers are getting challenged on their household balance sheets. Let me think about how to start to preserve and think about more defensive stores of capital rather than I need to wait for something to break and then I need to pivot.
It sounds like once something breaks, then you would almost be bullish in a way, because that's when we would expect easing to kick back in, right? So it's almost like you need to be cautious right now because it seems like something inevitably will break. Maybe that's a black swan event, especially if something does literally break. And then maybe that kicks off a bull run because there's no other option besides buying back those assets, right?
I think it's way too early to start thinking about pivoting back into risk assets until you see, hey, the pain is here. And now the Fed has pivoted. Okay, we still have a little bit of time for actually that stuff to move in and filter through to the broader economy, and for people to actually start to get healthier again in their balance sheets, and for companies to start to get healthier. What I do think would actually pivot really quickly back into risk on is what they did last time is, hey, we're going to send money right to people. And if you get money in your bank account, you're going to start to spend that. That does not take time. That's no lag. That is when, if that happens, that's a full send button. That's a full send.
For me, it always comes back down to what is the perception of the current administration and how are they making sure that the public is not suffering? And, because again, things are getting very political right now. Not that they're not always, but you do hear Biden announcing that he's running again, Trump announcing he's running, and you can't have a healthy campaigning season if you have everyone's hurting and they're pointing their finger and saying that you're the one that's doing this.
The Fed has the ability to control banks, absorb assets at a very high level. It doesn't have the ability to really affect everyday consumers and smaller businesses. Would the Biden administration send out checks again? Would they support that? Maybe. I mean, to your point, right? He's in an election fight. So, hey, what's a better way to vote, to want to vote for someone than they just set you $3,000? So I think that's on the table. The weird thing too is we're at this point where you're at like this May doldrums. You have this cycle in broader markets that show us that sell in May has been like an old adage that folks have always said, and whether or not that has rung true has always been a little tenuous in my mind. So just saw some recent data that you can actually look at May to October returns, like, hey, you're taking the summer off and you're going to come back in like the end of the year. And returns from May to October historically have been like, 5% in stock markets. In sort of that last half of the year, you get 17% on average returns. So to get to the normal average returns in stock markets, you've had basically, you take the summer off, you jump back in at the end of the year for the Christmas rally, and you've done really well. Just another thing to think about is you're kind of thinking like, hey, is it really time to take risk off? Am I really going to miss like this enormous rally? Even the seasonality perspective would tell you probably not. If we're thinking about crypto specifically, I think we've had folks say, okay, maybe the macros really challenged, like, okay, sell in May, I get that. But what about the halving? What's going, what are we going to get the halving run up? When are we going to have, when are we going to have that cycle? And if you look at the past halvings, we've had a few different periods so far. I think we've had 4 different halving cycles. You've seen the price appreciation by and large actually come at the halving date or after. We might get a little front running of it, but it's still okay to wait. The halving's projected for about a year from now, next April, May, depending on a few different things. But, even for that, you probably could wait. So, the game plan for me personally, and, I think maybe for you, Kyle, is thinking about, hey, we have the rest of the year to say, like, there are a lot of things that could go wrong, a lot of things against risk assets. Why not just, hey, take those 5% interest rates for a little while you're giving them out, and, we start to look for new and interesting projects as they come about.
So how would you treat a portfolio right now? Would you be all out of risk assets at this point?
Everyone's situation is different in how they're thinking about their overall portfolio perspective. I think it's really hard, despite all of the indicators I pointed to say I'm all out, because as we've seen the last few weeks and months with crypto, you could have said the same things and all the indicators I'm pointing to 3 months ago and missed a 100% rally. So all out or all in is never a good strategy. It's more, hey, I'm comfortable having 25% of my net worth in crypto, and long term, I know that's going to grow. Right now, I see a lot of pain coming. Maybe I dial that back to 20% to 15%, start to add some, US treasuries, and start to add some gold. There's a lot of on-chain options that are emerging for folks to invest in treasuries too. I mean, Ondo Finance is one of them that just comes to mind, and others that you could stay on chain, get 5% yield, and get out pretty quickly to move on to, an opportunity that you see if things do pivot.
What are we expecting to see, in the next week or two that might give us a bit more kind of a clear indicator of what to expect?
Okay, just to wrap us up here, what are we looking at for the next week ahead? What really matters? Federal Reserve meeting, we're looking at rate hikes, 25 basis points. You'll probably see that by the time this video comes out. What you need to be looking for, though, is how the Fed chair actually talks about rate hikes going forward, and all of the language that's saying, are we thinking about raising rates? Are we thinking about, slowing down? Are we thinking about even cutting? There's a lot of governors across the board who are saying different things, and you can see that in the Fed minutes they release, what that commentary is like, and that'll give us indications where we're going to be looking going forward. The things the Fed really cares about and are looking for, wages, which feed into, the inflationary pressures we've been seeing, unemployment, they wanted to see, that rising. Then they're also going to talk about the First Republic Bank collapse that we saw. So look for all of those things as they bring out the minutes. We're going to have more data on jobs at the end of the week. We're going to have more data on wages at the end of the week in the US. And all of that stuff is going to continue to feed into, what they're going to be doing for their June meeting, which is either pausing, most likely not cutting, but potentially pausing or raising rates one more time. As they're raising rates that one more time, tightening the environment, making it, even more punitive for companies, and continuing to put stress on the economy. So, really a big FOMC meeting, and the guidance is what is key. That's what you should be looking for.
And ideally, from a crypto perspective, like what is the most ideal outcome for us? What are we looking for?
Most ideal outcome is the Fed pausing 6 months ago, so we don't have all of these underlying things that could break in the economy. We want to see a pause quickly, but from a crypto perspective and from just a macro perspective, we want to see inflation coming down, and we want to have, quote unquote, a soft landing. So not too many jobs going down, but inflation coming down. So interest rates can come down, so we can start to, move some money back into crypto and other assets. It's been really interesting to see just how Bitcoin has responded and reacted with this First Republic news. If it continues to react positively to news like that, that is a signal that Bitcoin is becoming that risk-off asset, like we've seen with these banking crises. So, you got to continue to watch that part of the story.
All right, we're going to wrap it up. Tom, thanks so much for coming on. That was really, really insightful. Hope you guys were watching this, enjoyed it as well. If you did, make sure you like the video, share with everybody, because this is very valuable information. We bring it to you guys because we care, and we'll catch you guys on the next one.